Hello everyone, this is Kyoung Jang, and today I'm going to talk about the financial managing accounting. This is our agenda. It's accounting and business. I'm also going to talk about accounting for business transactions, trial balance and its purpose, balance sheet derived from the trial balance, conclusion, and the references. In the chapter 1, it introduces the multi-phase role of accounting in the business world. It explores the various applications of accounting, ranging from monitoring financial transactions to aiding in strategic decision making. The section on ethics in accounting emphasizes the ethical responsibilities inherent in financial reporting and highlighting the need for accuracy, transparency, and honesty. Moving on, the chapter also delves into transaction analysis, illustrating how accounting involves dissecting and categorizing financial events with the business to ensure accurate record keeping and financial reporting. Additionally, the chapter explains the significance of financial statements like the balance sheet, income statement, and cash flow statement, in offering a concise overview of a company's financial performance and overall health. In Chapter 2, it explains about the practical aspects of accounting for business transactions. It introduces a system of accounts, providing insight into how businesses categorize and organize financial information using the chart of accounts. Debits and credits, the cornerstone of double entry bookkeeping, are discussed in detail. This section allocates their critical role in recording changes to accounts and maintaining the balance of the accounting equation. The chapter proceeds to explain the process of recording transactions, emphasizing the importance of precision and consistency to ensure the integrity of financial data. The concept of a trial balance is introduced as a tool to validate the accuracy of recorded transactions by verifying that total debits equal total credits. Also, the chapter concludes with a comprehensive overview of how financial statements are generated, building upon the earlier discussions and showcasing how they encapsulate a company's financial performance and position. Trial balance and its purpose. A trial balance is a fundamental accounting tool used to organize and verify financial data within a business. It's essentially a list of all the accounts recorded in a company's general ledger with their corresponding debit or credit balances. The primary purpose of a trial balance is twofold. First, it serves as a critical error detection mechanism. By summing up the debit and credit balances, it ensures that the accounting equation stays in balance. In other words, the total debits must equal the total credits. If they don't match, it signals a potential error or omission in the accounting records. Secondly, a trial balance is the starting point for preparing financial statements, such as a balance sheet and income statement. It provides a snapshot of the company's financial position at a specific point in time, making it a valuable resource for decision making and financial analysis. To illustrate, let's consider a simplified example for a Airbnb business in the month of August. Let's imagine your Airbnb business has the following simplified trial balance for the month of August. In cash, we have $10,000 of debit. Accounts receivable, AR, we have 5,000 in credits. Furniture, 20,000. Accounts payable, 7,000. Revenue, 15,000. Rent expense, 3,000. In the example, the total debits $35,000 equals the total credits of $25,000, indicating that the trial balance is in balance. Balance sheet derived from the trial balance. The balance sheet is a critical financial statement that presents a company's financial position at a specific moment, typically the end of an accounting period. It encompasses two major categories, assets and liabilities, along with owner's equity. These categories are directly derived from the trial balance. To create a balance sheet from the trial balance, we have to group accounts as assets. All accounts with debit balances on the trial balance become assets on the balance sheet. These represent what the company owns. In our example, cash of $10,000, accounts receivable $5,000, and furniture of $20,000 are assets. Liabilities and equity. Conversely, all accounts with credit balances on the trial balance are grouped as either liabilities or owner's equity on the balance sheet. These reflect what the company owes and the owner's investment in the business. In our example, accounts payable, which is $7,000, falls under liabilities. Owner's equity is calculated by considering items such as retained earnings, which comes from the income statement, which is not shown in the trial balance, but it is included for completeness. Here, this is a simplified balance sheet based on the trial balance example, and the total liabilities and owner's equity will be $22,000. The conclusion is that we understand the accounting concepts like the trial balance and its connection to the balance sheet is crucial for financial management. The trial balance acts as a quality control tool, ensuring the accuracy of financial records and as a basis for creating financial statements. It should always balance with total debits equaling total credits, highlighting potential errors if not. The balance sheet derived from the trial balance presents a snapshot of a company's financial health, categorizing assets, liabilities, and owner's equity. When explaining these concepts to non-accounting professionals, simplicity and practical examples are key to empower informed financial decisions within the organization. These are the references I used, and thank you for listening.